Hello, Charlie Redding from Efficient Portfolio here. Now, we're obviously in the midst of a current financial crisis, and it can be pretty scary making that commitment to invest new money during a time like this. There's global panic, there's worry on the news 24/7, there's talk about the markets going down. So should you be actually investing new money at a time like this? I wanted to do a video about that. So what I'm going to do is I'm going to share my screen with you, and hopefully I can talk you through some of the concepts around investing at a time like this. Now, one of the concepts that I want to talk about is the fact that the future is better than that you think. The future, the world is constantly getting better and better. And whilst you might not believe it, I'm going to try and convince you of this over the course of the next few minutes, because actually this is one of the key things to believing that you should be investing at a time like this. And just let me give you an example. So for example, Uber and Hyundai are debuting flying cars at the CES technology conference this year. And so not only will they be rolling out flying cars like this in 2023, just 3 years from now, but not only that, but they reckon within a decade, the cost of traveling by flying taxi across cities and the like will be as low as current travel by owning a car is today. That's absolutely incredible. It's mind-blowing. Imagine getting across London or LA or any of these major cities in the air in minutes as opposed to hours of queuing. So it's just incredible technology. And I'm a big consumer of the stuff that Peter Diamandis does, including his Abundance 360 conference, which happens each year, 3-day conference on technology. Peter Diamandis in this year's conference said that we're going to create more wealth in the next decade than we did in the last century. That is incredible. We live in incredible times. And, I often hear people on our Facebook groups sometimes say that the world isn't getting better, but let's just be clear about this. Here's 4 charts. Extreme poverty has halved in the last 10 years. Child mortality is down 22% in that same period of time. World famine has dropped by a factor of 10. Global life expectancy has increased by 2.7 years over the last 10 years. And for the first time, more than 50% of people are using the internet. We've increased wind energy by 3 times in the last 10 years. We've increased solar energy by 10 times in the last 10 years. And by 2030, the potential contribution to the global economy from artificial intelligence alone will be $15.7 trillion. And that's a global GDP increase of 14%. That's just incredible. That's just as a result of artificial intelligence. And why is this happening? Well, if you think about it, over the years, what used to happen historically was that science drove technology. So science was what allowed technology to get better and better. And that's what allowed us to grow as a global economy. But actually now, for the first time in recent years, we're starting to see that actually science is being driven by technology. It is driving technology, but technology is now driving science. And it's absolutely incredible. So for example, there's a game called Go. It's a Chinese game. It's a bit like chess, but it's actually considered to be, or it is more complicated than chess. So it's considered to be the most kind of difficult for a computer to beat a human at. And in 2016, Google released their DeeperMind computer, and it beat the #1 Go champion, which was Lee Sedol. This is 2016, and the computer beat him by 4 games to 1. And this was a big deal. So step forward AlphaGo Zero, which was created just, I think it was last year, maybe, I can't remember that. But AlphaGo Zero beat AlphaGo. Now let's just be clear, AlphaGo beat the best human on the planet at Go 4-1 in 2016. AlphaGo Zero then played AlphaGo, which AlphaGo Zero was the new computer, and it won 100 games to nil. Now, why is that? Because what they did was they actually created 2 AlphaGo Zeros, 2 artificial intelligence computers that learned Go, the game Go, from scratch, and they just played against each other. So essentially, this is artificial intelligence teaching artificial intelligence, which is absolutely incredible. And that is how technology is going to actually help drive science as opposed to science driving technology. And in Abundance 360, Peter Diamandis talked about the 1920s, and he did a load of research to find what were the major inventions, what was the major innovations of the 1920s, a whole decade. And he could find just four significant innovations in the 1920s. It was the handheld hairdryer. It was the first commercial radio station. The Band-Aid was invented in the 1920s. And the 3-lens traffic light. Not monumental innovations, I'm sure you would agree. But that was 100 years ago. Let's just look at some of the things, just a selection of the things that happened in just 2019. So, EHang went public on the NASDAQ for $700 million, and they are going to be making flying cars. I've already talked about Uber and Hyundai debuting their flying cars at CES and rolling them out in 2023. And there's over 100 startups in this area, and companies like Waymo have done 10 million miles in the real world with self-driving cars. Tesla, through their autopilot system, have literally done millions, I think it's even billions of miles through self-driving cars. This is technology that's there today. In communication, we're rolling out 5G across the planet, which is going to give 100 gigabit speed, so no Wi-Fi. You can literally buy a TV, plug it in, and you can stream stuff straight to it, from anywhere that has a 5G connection. You've got a paralyzed man that has been walking through an exoskeleton that is powered through his mind. It drilled into his brain, connected it up, and he now walks through using an exoskeleton. Neuralink, which is another one of Elon Musk's companies, has started developing linking broadband to the brain with a computer interface. It takes 10 chips, and it will give a 2 gigabit connection speed. And he reckons that he will be connecting the first brain, which will be somebody that is unwell. It's not going to be rolled out across the masses, but by the end of 2020. And Google announced also that they've reached quantum supremacy with their Sycamore processor. What this means is that, and these quantum computers are just incredible. So this computer, Sycamore, can do a calculation in 200 seconds that would take the most powerful traditional computer on the planet 10,000 years to do. And you can actually play around with quantum computers in the cloud as we speak. From a health point of view, doctors treated an 8-year-old girl with a terminal brain disease called Batten with a drug designed and tested and approved for her in less than 1 year. So that drug was designed for her, tested, and then approved all in less than a year. That's absolutely incredible, particularly in the COVID-19 times that we're talking about at the moment. So I've used this chart many times in presentations, but it looks at the number of patents that applied for and the number of patents that granted and the stock market in the background. And what you can see is the stock market, yes, it has its blips, but ultimately it's benefiting from this constant progress, these constant increases in innovation, because it's the rate of which that we're that everything is accelerating, that's getting better, faster and faster. The stock market is a constant uptrend with temporary setbacks. If you don't believe that, then that's you're not going to want to invest. But ultimately, that is what human progression is all about. It's about saying, I can't know when it's going to turn out all right, but I know that it is going to turn out all right. But of course, there's always a malaise du jour, today's problem. And whether it was the Brexit vote, of course, in the lead up to Brexit, we all thought that the markets would crash if we had a vote to leave. And actually, what happened? The markets rallied because the pound weakened, and the performance of the portfolios and the markets actually did better. But that was the previous malaise du jour. And before that, it was trade wars, and it's been trade wars since that as well. There's always something out there. So we've got to think about, there's always things going on, but they are temporary dips in the market, and that actually the constant trend is likely to be upwards, because that's what's always happened. The second kind of principle I want to talk about is the behaviour gap, because over a 20-year period through 2007, the average equity fund returned 10.81% per annum. However, the average equity investor only got 4.48%. And why is that? The markets are delivering 10.8%, but the average investor's only getting 4.48%. That's because their head's getting in the way. So we've got to think about the behavior gap. Now, of course, we're in a bear market at the moment, and we've seen bear markets before, and we'll see them again. In fact, they're common as dirt. A bear market, in case you're not aware, is a downward market. So you've got a bull market is when it goes up, and a bear market is when it goes down, because the bull pushes its head up and the bear sweeps its claw down. That's where they come from. But they're common as dirt. We've had 13 bear markets since World War II. And over 63 years, we kind of get an average of about one every 5 years with a 30% decline. So that means if you're working for 40 years and retire for 30 years, you're likely to see 8 bear markets before you retire and 6 bear markets after you retire. That means you've got to embrace them. You can't just accept them, you've got to embrace them. You've got to see them as an opportunity to actually make more money. If times were more certain, then you wouldn't get the returns, which I'm going to come on to in a minute, that you do from investing in a bear market. That's the deal. And I love this kind of cigarette packet market cycle concept, that stocks are bid away from good investors by bad investors in euphoric times. But in times of market decline, they're sold back by the flapper to the wise and deserving investor at fire sale prices. That's what's happening at the moment. We've got great companies out there that just a month or two ago were trading at 25, 30, 40% more than they're trading at today. They're still a great company, but because of the worry, people are selling them at silly prices. And when we're investing, we're not investing in just a selection of a small selection of companies. It's all about proper diversification. So the key to diversification is that you'll never own enough of any one thing to make a killing in it, but you'll also never own enough of any one thing to be killed by it. This really is about saying, I don't care what's working at this moment in time. I care about what's always worked. And the modern portfolio theory and a properly diversified portfolio is what's always worked, always delivered the right returns over time. And in fact, it's not even just about the growth of the shares, because actually, one of the benefits of holding shares is that you get paid for holding them. You get paid dividends. And so actually, if you look at the long-term total return of just the FTSE 100, as this example shows, you're actually getting paid dividends even through the scary times to continue to hold those shares. Now, if you take those dividends out and just look at the capital growth, actually the values still hold true with inflation. But really, it's that growth that includes the dividends that's really important. And it's worth looking at a few charts to say, well, okay, how was investing at different times? How's that delivered returns for me? And if you invested at the peak of the market prior to the 1987 market crash, you would have seen from then through to March 2020 a 6.7% per annum return. But if you invested at the bottom of the market afterwards, which I appreciate is very difficult to do, then actually you got 8.2% per annum return. Again, if you got at the peak of the market prior to the technology bubble, you've had 2.8% per annum return to today. But if you managed to get in at the bottom of the market, you've had 7.4% per annum. I mean, these are really, 7.4% per annum is a great level of growth. And if you did the same, again, if you got the top of the market prior to the global financial crisis, the credit crunch in 2008, then you've seen 2.8% per annum returns from there to the end of March 2020, which of course is after the significant market fall that we've seen here. But actually, we've seen 8.8% per annum returns if you were invested at the bottom of the market. Now, this is another way of looking at it, and this is essentially a flip of the market. This is to show you what returns you've got for each of the different 10-year rolling periods going forward from 1976. So what it's saying is, if you invested at this moment here, you've had a 15% return, annualized return for the next 10-year period. So actually what that means is that if you invested just prior to the peak of the tech bubble, that is the only 10-year rolling period where you saw a negative annual return. But what you can see is during these sell-offs, then actually that's where your market returns really go up. That's where you can get the best long-term growth for your money. So let's look at this in a slightly different way. So this is the 1987 crash. Now, if you invested before it, your total return was kind of at this level. So let's say that's 125% total return over the following 10 years. Whereas if you invested at the bottom of the market, you got much better returns. So you're more like nearly 250% growth over 10 years. However, it's really difficult to know where the bottom of the market is, and that's the key point. None of us know until retrospectively. But whether you got in at the perfect times, or even if you got in at only acceptable times, you got maybe 200% growth over a 10-year period. And but what's interesting is if you left it really late and you just kept waiting and waiting and waiting, then actually your returns dropped significantly. The same can be said of the tech bubble. Now, if we look at the tech bubble, if you got in before, we've already said this, that's the 10-year period that you might see that you would have actually seen a market fall or a performance a negative return. But actually, what we've seen is that whether you got in too early, you still saw great returns. But if you got in at the absolute perfect point, you saw amazing returns. But the principle here is that you don't have to get in right at the perfect time. You just have to get in when the markets are down and it delivers great returns. The same with the global financial crisis from 2008. If you got in right before the market crash, you still had positive returns. If you got in right at the bottom, you had amazing returns. But if you got in anywhere vaguely close to the bottom, you got great returns over the following 10 years. So the key really is that time in the market is better than time in the market. You should just try and get in, get invested. Don't worry about whether the markets are going to get slightly worse over the next few months or slightly better over the next few months. Stop trying to time the market and just say, look, at the moment, the market is presenting me with significantly more value than it was before. Get that money invested, and because in time, you will see the long-term benefits of that. And ultimately, the secret to long-term growth is withstanding short-term losses. So I've already said about it, But in that next 10-year period that you're investing, or even the 5-year period, you may well see another bear market, and you've just got to withstand that, because long-term growth will come if you do. And I'll leave you with one final thought, which is from Warren Buffett. Is someone sitting in the shade today because someone planted a tree a long time ago. It's about planting those trees and if you can do it at the right time, then that's where the long-term growth will happen. So at Efficient Portfolio, we have a team of financial planners that are more than happy to talk you through this, because as I pointed out with the behavior gap, we instinctively make bad decisions with our money. And therefore, it's the advice and guidance of experienced people that have been through several market crashes that can help make sure that you don't make poor decisions with your money. As always, we'd love to help you if we can. So you can contact us by email, on our website, or by telephone. Just pick up the phone, send us an email, click on the Efficient Portfolio website, and we'd love to help you move forward if we can. So whatever the current malaise du jour is, you just got to focus on the long term. The world is getting a better place. It's getting better and better. You've got to focus on that, and you've got to focus on the fact that actually as individual investors, we make bad decisions. And so therefore it's about time in the market rather than time in the market. It's about withstanding short-term losses to get long-term growth. It's about just getting involved, because as long as the world continues to get better and better, more and more patents will be applied for, more and more patents will be granted, more and more things will be invented, and the world becomes a better and better place. And as an investor, you piggyback on that journey. So stay safe, and if we can help you at Efficient Portfolio, we would love to. Please just get in contact with us in whatever ways best for you, and we'll help you in any way we can. Thank you.